Imagine waking up tomorrow, checking your bank account, and seeing 1 million sitting there. Not 10,000, not a side hustle win, 1 full million in cash. Now the real question hits you immediately. What do you do with it? Because letting it sit idle feels irresponsible, but rushing into the wrong safe investment could quietly cost you tens of thousands of dollars over the next year. In 2026, choosing where to park a large amount of money is no longer a boring decision. It's a strategic one. Interest rates are shifting, inflation hasn't disappeared, and banks are competing harder than ever for big deposits. Today, we're putting two of the most popular low risk options head to head: money market accounts and fixed deposits. No hype, no complicated finance talk, just real logic, real numbers, and real outcomes. By the end of this video, you'll know exactly which option makes sense for you if you had 1 million to invest in 2026, and more importantly, why. The reason this comparison matters so much right now is because 2026 is a transition year. We're coming out of aggressive interest rate cycles. Inflation is lower than its peak, but still high enough to erode purchasing power, and central banks are signaling caution. When you're dealing with small amounts of money, these shifts barely register. But with 1 million, a difference of just 1% means $10,000 per year. That's not pocket change, that's real money you either earn or lose simply based on where you park your cash. So, this video isn't about chasing extreme returns. It's about making smart, calm, rational decisions with large capital. Let's start with money market accounts. At first glance, they sound dull, and honestly, that's part of their appeal. A money market account is essentially a bank account that invests your money in very short term, low risk instruments like treasury bills, interbank lending, and high quality commercial paper. The goal isn't explosive growth. The goal is stability, liquidity, and modest returns that beat a regular savings account. Your money is always working, but it's never taking big risks. That's why businesses, high net worth individuals, and conservative investors often use money market accounts as a place to park cash while waiting for opportunities. In practical terms, a money market account typically pays interest monthly, allows limited withdrawals, and keeps your funds highly accessible. The interest rate isn't locked in, which means it can move up or down depending on market conditions. In a stable or rising rate environment, that flexibility can work in your favor. In a falling rate environment, your returns can shrink quickly. But the trade off is peace of mind. Your money is liquid. You're not locked in. You can react fast if something changes. Now let's put real numbers on it. Imagine it's 2026 and the average money market account is paying around 4.5% annually. You invest 1 million. Over the course of a year, that earns you roughly $45,000 paid monthly. That's about $3,750 landing in your account every single month. That income can be reinvested, saved, or spent. It's predictable, calm, and flexible. But there's a downside most people ignore. If interest rates drop mid-year, your return drops with them. Money market accounts respond fast to market changes, which is great on the way up but painful on the way down. Now let's shift to fixed deposits. Fixed deposits are the classic set it and forget it investment. You agree to lock your money away for a specific period: 6 months, 12 months, 2 years, sometimes longer, in exchange for a guaranteed interest rate. Once you sign that agreement, the rate doesn't change. The market can do whatever it wants, but your return is locked. That certainty is the biggest advantage of fixed deposits, especially in uncertain economic periods. The downside is obvious. Your money is no longer flexible. If you need it early, you'll usually face penalties or lose interest. So, what does that look like with 1 million in 2026? Let's say banks are offering around 6.2% on a 12-month fixed deposit. You invest the full million, lock it in, and come back a year later with $62,000 in interest. Compared to the money market's $45,000, that's a $17,000 difference. For many people, that alone makes the decision feel obvious. But here's where it gets tricky. If interest rates rise later in the year and new fixed deposits start offering 7%, you're stuck. You can't upgrade. You already made your bet. Before we go further, let me ask you something, and I want you to answer honestly. If you had 1 million today, would you choose flexibility or guaranteed returns? Type money market or fixed deposit in the comments. And if this breakdown is helping you think more clearly about your money, take a second to like the video and subscribe. This channel is all about practical investing decisions, not hype or shortcuts. Now let's continue. At this point, most people focus only on interest rates, but that's a mistake. The real enemy is inflation. If inflation in 2026 averages around 3.5%, your real return is what's left after inflation eats its share. That means a money market earning 4.5% is really only giving you about 1% in purchasing power growth. A fixed deposit at 6.2% gives you closer to 2.7% real return. On paper, fixed deposits win again. But investing isn't just math, it's psychology. Can you truly lock away $1 million and not touch it for a year or more? What if an emergency comes up? What if a business opportunity appears? The best investment is the one you won't panic break halfway through. That's why many experienced investors don't choose one option. They split the money. For example, 500,000 goes into a fixed deposit at a higher guaranteed rate, while the other 500,000 stays in a money market account for liquidity and flexibility. This creates a blended return that's higher than pure liquidity but safer than going all in on a lockup. It also reduces regret. No matter what the market does, you feel prepared instead of trapped. So which option is better for investing 1 million in 2026? The honest answer is that it depends on your priorities. If you value liquidity, expect interest rates to change, or want quick access to your funds, a money market account makes sense. If you want certainty, don't need the money for a while, and believe rates may fall, fixed deposits are powerful. And if you want balance, splitting your capital is often the smartest move. If this video helped you avoid a costly mistake or gave you clarity about where to place serious money, do 3 things before you leave. Like the video so it reaches more people who need this information. Subscribe for clear, real-world investing strategies. And comment part 2 if you want the next video to cover bonds, treasury bills, or building a low-risk income portfolio with large capital. Your money deserves strategy, not guesswork. I'll see you in the next one.